Thank you.
Senator Warner.
Thank you, Mr. Chairman. Let me also thank you and the ranking member for holding this hearing. I want to go back to some of the comments that Senator Reid and Senator Toomey made. I share, Chairman Schapiro, your concern that if you've got to have an intervention, and whether that intervention is de minimis or large, if it's breaking the buck, it has the potential of starting an unraveling. The interesting thing, though, is that when we look at the FSOC, normally we go after the largest systemic important institutions. My sense is, and I'm anxious to see the data as well, that the largest money market funds are probably the safest in terms of shoring up if they get into this gray area. And it really is the smaller ones, the ones on the fringe, that may be providing the most threat to the system. And I guess this again goes back to, I want to comment a little bit more about Senator Reid's questions about, and I know there's not an equivalency of some type of stress test or analysis. Could you speak to that a little bit more?
Sure. I think, excuse me, I think the stress test is an interesting idea. Stress test with respect to the capacity to provide capital. I think the problem is, if there's going to be capital support, it ought to be explicit capital support. Investors ought to be able to know that it will be there when it is needed, not be left to wonder whether the sponsor is still capable of providing that support, still willing to provide that support. And I think that's why my view is that we need to move forward with a rule that would require either a floating net asset value or a capital buffer coupled with some kind of redemption fee or limitation in order to ensure that those who redeem early are bearing some of the costs.
So in a sense, no differentiation between those money market funds who've had long, stable relations, everybody would be in the same pot, right?
Well, I think...
and with the capital buffer, if we're going to go on the capital buffer, would the capital buffer be for a Lehman-style collapse, or would the capital buffer be just to kind of in the normal course to have a small reserve here so that if there was something that kind of got you near that de minimis cushion?
I think one of
or would that be part of the review and analysis?
Well, that's certainly part of the analysis, but the reserve fund was about a $62 billion fund, not a household name, I don't believe. They held only about 1.2% of their assets were in Lehman paper, $785 million investment. When they broke the buck, yes, admittedly, it was in a time of general crisis in the economy, but it spread rapidly to many, many other money market funds. And if you read former Secretary Paulson's book, he talks about really standing on the edge of the cliff, hearing from money market fund managers who just didn't know what was going to happen to them because redemptions were going through the roof. And if they were going to have to sell securities in order to meet redemptions into this very depressed market, they were going to create this spiraling down that would be very, very difficult to stop, which is why Treasury did step in and to the tune of more than $3 trillion guarantee all money market funds.